All right, so we are doing the final accounts adjustments. Final accounts adjustments are simply the single entity financial statement adjustments. So when we have the question from the final accounts or the single entity financial statement in the exam, usually we have the trial balance being given. For example, this is the question price well. So you can see the trial balance is given in the exam. This is the debit side and this is the credit side. And then this is the requirement. Prepare the statement of profit or loss and other comprehensive income, and prepare the statement of the financial position. So these are actually the requirement of an exam question, the single entity financial statement exam question. So within the adjustments, you have adjustments from different standards, and every question is different, but there are 5 main standards from where you get the regular adjustment in the single entity financial statement question. First of all, IAS 16. This is one of the regular standards that you see within the single entity financial statement question, IAS 16. And then we have IAS 12, the taxation adjustment. Again, this is one of the most common adjustment within the final account question, and I don't remember any main question without this adjustment. Then we have IFRS 9, financial instruments. Again, either it's actually the loan note simple or debentures, or sometimes you have the convertible loan notes. Then the revenue, IFRS 15. So the adjustments related to, for example, the construction contracts, or for example, sometimes you need to make some adjustment to the revenue. For example, they have recorded the complete revenue. Instead, they should have recorded the commissions, agency commissions or agency fee. And then we have IFRS 16, which is about the leases. So these are the main standards which you see on the regular basis in the single entity financial statement questions. You may see other standards as well. For example, sometimes it's related to the provision, then you apply IAS 37. Sometimes when it comes to the impairment, you apply IAS 36. So in order to solve the single entity financial statement question, you need to have the grip on the standards. But these are the main standards that you need to do first of all before doing any single entity financial statement question, because you regularly see these adjustments coming up over there. Sorry. Now I'm going to start with the lease, IFRS 16, and I'm not going into the detail of IFRS 16. I'll just talk about the workings. So IFRS 16, so we have two things. First of all, you have the right of use asset, and then you have the lease obligations. So you have the right of use asset, and then you have the lease obligation. The right of use asset is simply depreciated, on straight line basis over the lease term, usually. But for example, if the asset will be transferred to the lessee by the end of the lease term, then we take the useful life. Sorry. Otherwise, we take the lower off. And usually in the final account question, we simply depreciate the right of use asset on straight line basis over the lease term, whatever it is, 4 years, 5 years, whatever it is. In the lease obligation, we have two sort of things. Now, lease payment in arrears and lease payment in advance. And I will clearly explain this in the leases lecture. And you can see in the slides as well. So the working in the area is opening balance, and this is the present value of obligations. Then you add the interest on it. Interest is always applied to the opening balance, percentage into the opening balance, and this is the effective rate of interest, which is simply the implicit rate of interest. And then you deduct the lease payments, which are the fixed lease payments, annual lease payments. Then you get the closing balance. And remember, we do an extra year working in order to split the liability between current and non-current. So we do an extra year working. So let's assume in the exam they are asking you regarding X3, then you need to do the X4 adjustment as well. This is just to split the liability between current and non-current. The second year balance represents the non-current liability, and the difference between these two represents the current liability. And this interest goes to the profit or loss. This is the finance cost. Then you have the working of the lease payments in advance. In the exam, you need to clearly see how they are making the payments, whether it is the lease payment in arrears or lease payments in advance. Again, first of all, taking the opening balance, this opening balance represents the present value of lease payments. Then you deduct the payment. And then you apply the interest. And this is the closing balance. Again, it becomes the opening balance of the next year, then deducting same payment. This is the subtotal. Again, adding the interest, and then you get the closing balance. So this is how it is being done. So the subtotal represents the non-current liability, the subtotal of the next year. And the difference between these two represents the current liability. So this is how you do the working of arrears and in advance. So the right of use, it is simply depreciated over the lease term on the straight line basis. And then you have the lease obligations. So for that, you need to see whether the payment is done in arrears or the payment is done in advance. That arrears means by the end of the year, advance means at the start of the year. So with the arrears, you apply the interest on the opening balance and then you deduct the payment. With the advance payment, you deduct the payment from the opening balance to get the subtotal, and then you apply the interest on that subtotal balance. So this is how it is different from the working in arrears. Now, whenever you have the adjustment from the lease within your single entity financial statement question, you see, first of all, the lease liability balance, just like this. Lease liability, and it is on the credit side because it represents an obligation. And then it says there's a note number 1 relevant to this. And you just go to the additional information. The right of use plant was acquired on 1st April 20x7. The rentals are 6 million per annum for 4 years. So the lease term is 4 years. Interest rate implicit is 8% per annum. Right of use plant is depreciated over the lease period, which is 4 years. So again, going back to the trial balance, and you see there is a right of use asset over here at cost of 20,000. So as I said, you just take the cost, which is 20,000, divide by lease term, which is 4. So you get the depreciation of the right of use asset simply of 5,000. Then for the lease obligation, you take this balance, which is the opening balance, and it says the rental are 6 million per annum in arrears. So it is clearly mentioned over here. So you just go and choose the working of opening balance. And opening balance is given in the question, 15,600. And then you apply the interest on it. So interest is opening balance, which is 15,600 into the percentage, which is the implicit rate of return given here as 8%. So simply 8%. So 15,600 into 0.08. So you get 1248. And then you deduct the payment. Now the payment is given as well, which is 6 million. So we are working in the 000. So 6 million represents 6,000. So this is your closing balance. So 15,600, we add 1248, and then, sorry, 15,600, we add 1248, and we deduct 6,000. So it's 10848, which becomes the opening balance of the next year. And then you apply the interest on it. Again, 0.08. It's 868. And then you deduct the same payment from it to get the closing balance. So 10848 plus 868 minus 6,000. So it's 5716. This 5716 represents your non-current liability, and the difference between these two is the current liability. And this 1248 is the finance cost in the profit or loss. So this was the question price well from your Kaplan kit. Okay, so we can see other questions as well. So this was the preparation of the single entity financial statement price well question. Next question we have Highwood. So let's see, do we have anything related to the lease in this trial balance? No, so let's skip this question. Then we have the Keystone. In the Keystone, do we have anything related to lease? No, let's skip it. Okay, now we have the next question, which is Fresco. So do we have anything related to the lease? Yes, we do have lease payments, note number 2. So let's go to the note number 2. Okay, on 1st April 20X1, Fresco acquired an item of the plant under a lease agreement that had an implicit cost of the 10%. And you will find that every question is same. The lease payment in the trial balance represents an initial deposit of 2 million. And the first annual rental paid on 31st March 20X2. Now they have not mentioned whether it's the payment in advance or in arrears. By wording, they have not mentioned, but by date, you can see they entered into the lease agreement on 1st April 20X1, and they made their first annual payment on 31st March 20X2. That means by the end of the year. So this represents lease payment in arrears. The lease agreement requires further annual payments of 6 million on 31st March each year for the next 4 years. So they made first payment, and then they need to make the next 4 years further annual payments of 6 million each year for next 4 years. So that means they are going to make total 5 payments. The present value of the lease payments, excluding the initial deposit, was 23 million. So initial deposit is not taken into the present value of obligations because that has already been paid. So again, we take the opening balance. So just like we did it, opening balance and dollar into 000. So 23 million. That means 23,000. And then we add the interest on it. Interest is 23,000 into an implicit rate was 10%. So that gives you 2,300. And then we deduct the payment from it. Payment is the fixed lease payment, which they have mentioned is 6 million per annum. So that is 6,000. So you get this as a closing balance. Again, using the calculator. So 23,000 plus 2,300 minus 6,000. So you get 19,300 closing balance, which becomes the opening balance of the next year. And again, 1930, which is the 10%, and then deducting the same payment again, 6,000, then you get the closing balance. So it's 19,600 plus 1930 minus 6,000. It gives you 15,230. Now again, this 15,230 represents your non-current liability. And the difference between these two represents your current liability is minus 19,300. So it's 4,070. So non-current liability, and this is the extract for the financial statements. In the non-current liability, you take 15,230. In the current liability, you take, how much was it? 19,300. I just forgot the figure. 15,230. It's 4,070. And then we have this finance cost, this one, which goes to the profit or loss of 2,300. So these are the extracts for the financial statements. This is how it is being done. And regarding the right of use asset, so regarding the right of use asset, so you just depreciate it over the lease period. Okay, then we go to the next question, which is Quincy. So let's see, do we have any lease thing within this? No, we can't see any lease thing in this. So just let's skip it. And then we have Atlas. Within the Atlas, no, we can't see any lease scenario in it. So again, let's skip this question as well. Let's go to the next question, which is Moby. Okay, yes. So lease liability of 29,300. And again, there is a note number 2 with that. So as I said, all the question looks same. Lease plant was acquired on 1st October 20x1, and the year end is 30th September 20x3. So the lease plant was acquired 2 years ago from the reporting date. Under a 5-year lease, which has an implicit rate of 10%, the rentals are 9.2 million per annum payable on 30th September each year. Now, 1st October is the date where we enter the agreement. And when we make payment on 30th September, that represents the payment in arrears. So usually we have the payment in arrears scenario. So again, the same working. There's nothing special in it. Same working. So check the opening balance. From the trial balance, here we have this, the lease obligations. It's 29,200. So it's 29,300, sorry, 000. And then we add the interest on it. Interest is the implicit rate, which is given in the equation of 10%. So 29,300 into 10%. So it's 2,930. And then you deduct the lease payments, which is the fixed lease payment. The fixed lease payment is 9.2 million, that is 9,200. And then you get the closing balance. So it's 29,300 plus 2,930 minus 9,200. So you get 23,030. And this becomes the opening balance of next year. Again, we take the 10% of it, so 0.1. So it's 2303. And then deducting the same 9,200, which is the fixed lease payment. So yes, 2303 plus 23030 minus 9,200. So this 16133 represents your non-current liability. And the difference of these two represents your current liability, that is minus 23030 is 6897. This is your current liability. And this goes to the profit or loss as the finance cost. It's 2930. So these are the extracts for the financial statements. So this is how lease working is done. It's quite simple, and every question is same. There's nothing special in it. Every question is same. So now you can practice the further question from the Kaplan kit and the past papers, and this is how the lease adjustment is done.